Hi everyone, my name is Andrew Palillo, Director of Member Strategies and Solutions here at the bank, and thank you for joining us today for our latest case study where we will look at how to find relative value with break-even rate analysis. So let's start out by looking at the wild ride that the yield curve has been on over these last few months. So in the graph on the left-hand side, we can see the shape of the classic advance curve in green as of October 31st, 2023, and then in blue where the classic advance curve was as of the end of January. And we can see the curve was higher and less inverted in October versus where we were in January of 2024. And the driver there was the market expectations changing and the much anticipated potential for the Federal Reserve to cut short-term rates after this incredibly historic hiking cycle that we've been through these last 18 to 24 months. So we saw the curve start to move down, and we can see that as evidenced by in the table on the right-hand side, that when we look at the steepness of the yield curve, so the relationship between a short point and a longer point, that spread has decreased considerably in the various different combinations. So whether it was already inverted, it got more inverted, and we'll get into in a few moments here some of the implications of what that inverted curve is telling us. So you can see the question up top here, which is a very important, relevant question in these times. Is when we think about incremental funding, do we look to fund short or do we fund long? And there's a number of factors certainly that play into that, and we can bucket it in two ways, and we'll look at that right now. The first component would be on the right-hand side in green here, more of the interest rate risk, interest cost side of things, and how will the total cost of the strategy fare, whether we're funding short or long, versus an alternative approach. And a couple of the considerations that we have to factor in are what's priced into the market and the yield curve right now, and we'll follow up with that on the following slides. But then there's also the component of what is the potential for those market expectations to change over time. Then another thing that we have to bring into play here is from a total balance sheet perspective, what is our interest rate risk profile, and what does the balance sheet need, both in a current snapshot, but over time in various different changing rate scenarios. And that's certainly something that we have seen over these last 2 years, as many members have expressed to us that where they were previously asset sensitive, that the changing dynamics on the balance sheet and with market interest rates have flipped them to a liability sensitive or more neutral rate positioning. Now on the left-hand side, it talks more about the liquidity aspect of things, so less about where the cost or the value is in terms of what the yield curve is offering us. So really the question that needs to be asked is, how long will I need this wholesale funding? Yes, I need it right now, and I might have some motivation to hedge interest rate risk. But some of the considerations that we need to think about is what do we think deposit growth is going to be? And with this rapid rise in rates over the last 12 to 24 months, the environment for the gathering and the retention of deposits has been as challenging as it's been in many, many decades. Forget a shorter period, but really over the very, very long term. So the current environment right now, and we hear that from members in terms of deposit growth, budgeting and forecasts and expectations, it's very challenging to see or to expect ample amounts of deposits to come in over the near term, at least with rates where they are right now. So that that would suggest that the need for wholesale funding is going to continue for a while. The other side of the coin there is what are the expectations for loan growth? And as weak as deposit growth has been over the last few quarters, loan growth has been exceptional, and it's settled into the mid single digits for many these last few quarters, which is down from the double digits for most going back into 23 and 22. But conditions are still ripe, and the demand from what we're seeing and what we're hearing from members, loan growth is still robust. But there's decisions to be made about how much more of that growth in this inverted yield curve environment, and considering capital ratios, how much do we want to continue to move along there? The other component of the liquidity needs, or the potential liquidity needs, is how much can organically come back to us from asset prepays and pay downs. Now, normally, we think back to 2019 when the yield curve had a similar shape to what it has right now. The need for wholesale funding was less than what it is right now, and the reason for that is all about the path of interest rates. And in that period in 2019, when the yield curve inverted, we saw an exceptionally high level of prepayments on mortgage assets, whether it's investments or mortgage loans on the books, because of where rates had been over the near history versus where they got to in 2019. So for the incremental loan growth, there was the opportunity to have that funded from asset cash flows. Now we're in a little bit different environment where we have a large portion of the mortgage book is at much lower rates than where market rates are, to the tune of 200 to 400 basis points below. So it would really take a substantial decline in intermediate term rates to see a meaningful amount of cash flow acceleration come from the existing assets that would be there to fund possible further balance sheet needs. So what we'll do here is we'll look at three different scenarios and three different ideas where we're debating between a couple different funding strategies. And, we're going to look at some scenarios where what might happen over the near term in terms of moves in interest rates. And it comes back to the title of this case study, finding the break-even rate. So when we do this type of analysis that we'll see in a little bit, we can compare two different strategies and look at the trade-off between what the cost savings may be initially, but how much would rates have to go against us in whatever direction, depending on the particular strategy. How much would rates have to move in order for the economics to flip and one strategy to look better than the other strategy? And that helps us inform the decision that we ultimately want to make. If the break-even rate and the amount of cushion that we have is sufficient to your risk tolerance. So the first thing we'll look at here is debating between taking out a 1-year advance versus rolling short-term. In this case, we'll use 3-month advances for a period of 12 months. So one common refrain that we hear from members an awful lot lately is that, well, we're staying short on our funding because we expect rates to go down in the short term. And certainly we've referenced it before. We can look at the probabilities for rate cuts over the coming Fed meetings, and certainly many market participants and prognosticators are expecting short-term rates to go down. Now, what is important to remember here is that the yield curve is just simply a pricing mechanism. So, there's not many or any really free lunches when we're talking about interest rates. So when we have an inverted curve, very simply, what is that telling us? When we see the yield curve invert, when we see intermediate or long-term rates move below short-term rates, that is the market telling us that the expectation is that short rates will be lower in the future. So to summarize, when we look at a 12-month rate that's lower than the 3-month rate, it is being priced in the short-term rate being lower in the future than it is today. So let's look at this example. So as we pulled these rates recently, the 3-month rate was at 550 compared to the 12-month rate at 482. So the way yield curve arithmetic works is that there's an implied rate for every step along the way if we were to borrow at 3 months and replace, borrow again for 3 months and then replace, all the way out to a term of 12 months, and it should be equivalent to the 482 because that is what the market is building into their expectations today. So in this example here, what's implied for months 4, 5, 6 from the shape of the current yield curve is that that 3-month rate 3 months into the future is lower. It's at 514 today. For that next period of 3 months, months 7, 8, 9, it's even further down, 451. And then for those last months, 10, 11, 12, it's that much further down. So when we think about borrowing at 482 today versus borrowing at 550 and then having the uncertainty of where rates may be going in the future, what it nets out to is that the implied rate for that month 10, 11, 12 is over 130 basis points below the current level. So like we said before, the expectation of lower short-term rates is priced into the yield curve when we see this type of inversion. So any decision making that you'd want to have is going to be predicated off of the fact that, do I think the expectations have swung too far in one direction or the other? So if you think that some of the rate cut euphoria is overblown, then it would behoove you to look to nudge out the yield curve and take advantage of what's being priced in before any of that upward movement or normalization occurs. Now let's look at a second example where we want a little more flexibility, that if rates go back up, but if they do accelerate to the downside here. So a popular strategy for many members is to utilize our daily cash manager advance, our overnight advance that provides great flexibility late in the day to get overnight borrowings to manage very short-term liquidity needs. So we also have a floating rate advance called the SOFR Index Advance that provides many of those same repricing benefits, but affords you some of the benefit of the longer-term liquidity, and we'll get into the spread risk benefits of the floating rate advances as well. So you can see here in the top left, the daily cash manager was recently priced at 550, and we can look at some of the examples for the SOFR Index Advance at various short terms, 1, 3, 6, and 9 months. And the way that all-in rate is derived is it starts with the SOFR index at 532 and then adds the spread for the advance. In this case, 18 basis points for the 1, 3, and 6 month, and then 20 basis points for the 9-month advance. And you can see when you add those up, the day one rate is equivalent for the 1 month, 3 month, and 6 month SOFR relative to the daily cash manager. Now you may be asking, why would I do this? So there's a couple benefits. One thing that many folks tell us is that the daily cash manager, while convenient, can be operationally burdensome in terms of consistently having to come in every day and refund whatever portion amount that you may need. So the SOFR Index Advance would afford you that ability that it's going to price and moves as short-term rates go. So if SOFR went from 532 unexpectedly to 3%, well, then you would move down the 200 basis points right along with that. The other component is the spread risk that we talked about. Oftentimes in periods of stress, having to constantly replace and reprice the advance, that we do see spreads widen out occasionally. So, but the way that the floating rate advance works is that the index may vary, but the spread that you lock into at initiation is fixed for the life of the advance. So you have some risk mitigation there. So the graphic at the bottom just looks at an example of a laddered funding strategy where you may have a portion that you're funding from a daily cash manager and looking to utilize some of those floating rate advances. We're pushing them out across a period of 1 to 9 months. And it's often prudent to keep some portion very, very short overnight, because if you're managing your liquidity, you want to have that flexibility to give it back if you have deposit inflows or asset cash flows or whatever the case may be. But you still get the liquidity benefits of having the longer term advances on the books. But your repricing is going to be exactly the same. You're going to get the benefits of, if rates do turn down, you'll be able to seamlessly and efficiently reduce your interest expense. Another popular strategy of late for many members in this inverted yield curve environment where interest rate volatility continues to persist at very high levels is using our HLB option advance. And that, if you're not familiar, is a puttable advance where the rate that you're able to capture can be below the classic advance curve. And that's because you're selling the options of the Federal Home Loan Bank of Boston to be able to take the advance back at predetermined intervals. So it's very similar to make the comparison on the asset side. Much like when you debate buying a treasury bond versus a mortgage-backed security, and there's a reason why there's more spread available in the mortgage-backed security versus the treasury, because you're able to, you're taking the uncertainty of the cash flows, right? It may be a 5-year average life, it may be a 7-year average life, it may be a 3-year average life. So for taking on that variable cash flow risk, you're getting compensated by extra spread. So as we flip it back over to the liability side, that's why you're able to borrow at lower rates than what you can on the classic advance curve. So here we're looking at an example on the left-hand side where a HOB option with a 3-year maturity and 1 year of lockout period is priced at $391, and we're comparing that to the 1-year classic advance at $498. So right off the bat, in that first year, you're capturing over 100 basis points of savings. But because with the classic advance, at the end of 1 year, the advance is done, and you can replace, you can not replace, you can do whatever you need. But with the HOB option advance, you're subject to that it may get exercised or it may continue to stay on the books. So we can do the arithmetic and say, how far would rates have to go down for the cost savings advantage for the HLB option to move in favor of the classic and replace strategy. So you can see the dashed blue line on the bottom. So for assuming that if we were to stress test and say the HLB option did extend fully out to maturity, well then the replacement rate would have to be 338 in this case. So, and that rate can come from the marginal short-term borrowing rate. So that is over 220 basis points right now versus that rate. So there's an awful lot of cushion for rates to go down for the economics to still be in your favor. It could also come from deposits or any other type of funding as well. Along the right-hand side, you can see some of the nuance with whatever horizon that we look at. So I just mentioned that in that stress test, we're assuming that the HOB option fully extends out to 3 years. Well, because of the quarterly put option that is embedded into the advance, it may get called at the 12-month mark after the lockout. It may get called every quarter thereafter, 15, 18, 21, 24 months, and so on. So again, we can calculate the break even at all of those different intervals to see where we would stand. So the shorter the horizon, the lower the break-even rate would have to be, the more cushion that you're afforded by capturing those cost savings right now. So in this example here, if the advance were to get exercised at the 24-month mark, a year before the final maturity, well then the break-even would have to be 284 for that incremental period after the lockout. Again, versus where rates are right now, that is a considerable amount of cushion for rates to move down. And again, you're booking a fair amount of savings for year one. So that brings us to the end of the case study. Hopefully you found this exercise of being able to look at the break-even rates useful. As always, if there's anything that we can do to help with any of these analytics and the thought process as you debate, which direction you go on your advanced usage, we are here to be of assistance. So please feel free to reach out to your relationship manager or to me directly, and we'll be happy to have a conversation and support you in any way that we can. Thank you very much, and have a great day.